The separation of industrial and financial capital refers to limiting the union between banks and corporations. In other words, it regulates the companies engaged in industrial activities so they cannot dominate the financial industry, collecting customers' money to conduct business. A bank is obligated to help a company when it has control over that company. This makes it challenging to reach a fair decision regarding loans because it curtails fair and open competition among businesses. Additionally, if financial capital is dominated by industrial capital, it is very likely that the bank will continue to support its weak companies financially, which could have an impact on other financial firms as well as the Korean economy as a whole. Since 1995, Korea has strictly adhered to laws governing the separation of industrial and financial capital. The restrictions on ownership of industrial or financial capital, however, have recently been loosened by the government. This is so that financial companies won't be hindered from entering non-financial businesses and pursuing new business opportunities by the current regulations on separating industrial and financial capital. The government wants to give banks more business options so they can get involved in sectors like information technology, real estate, and delivery. The dissatisfaction of existing financial companies became the background to the policy to loosen the regulation. IT companies, such as Kakao and Naver, made their way into the financial industry with Kakao Bank and Naver Securities, respectively, threatening the realm of existing banks. Existing financial firms have pushed for regulatory easing so they can actively participate in non-financial businesses. Additionally, the government has come under fire for unfairly applying strict regulations to only financial institutions. The policy to relieve the separation of industrial and financial capital results from these opinions being reflected. With the loosened restrictions, banks are expected to enter new industries more actively. Once the regulations are lifted, banks can further strengthen online loan and insurance brokerage platform services and maximize synergy with lifestyle-related services such as delivery, real estate, and healthcare. However, there is also concern that the foundation of the separation between finance and industry should not be disturbed even though some deregulation is necessary. This is because once banks begin to enter other sectors freely, there is a risk of unfair trade, such as one-sided support for their own subsidiaries. In response, experts suggested that on-site supervision should be strengthened at the same time as deregulation. The IT industry is also in an emergency. If financial companies that have been operating in the existing financial industry enter non-financial businesses, there is a high possibility that they will have greater synergies, and in turn, the competitiveness of companies could decrease.